There's a question here on the screen. The question says, the Hope Company has an all equity capital structure of 200,000 common shares with the market price of $50 a share. The firm is considering a 5 million expansion, which can be financed with either first one, all common stock at $50 a share, or the second option is all bonds at 10% interest. If Hope's tax rate is 40%, we're asked to find out what's the EBIT-EPS indifference point for the two alternatives. That is what we are supposed to find out. Now, when we look into this particular data, we see that number of shares are 200,000. It's given here. Number of common shares at present, the given data is 200 common shares, 200,000 common shares. The price of per share is $50. The other details we have is if Hope's tax rate at present is 40%. So tax rate is 40%. That's the present scenario. Given situation is we have this information. They are now considering an expansion with an amount of $5 million. $5 million, that's the expansion amount. So they are now thinking about either going for raising this finance of 5 million through all common stock, that is a share issue, or thinking about going for raising the capital through bond issue. Okay. So proposal one, if we put it as all common stock, proposal two as all bonds. So how many shares would they be issuing? Each share is worth $50. Now they want 5 million. So 5 million divided by 50. So that would be number of additional shares. So 5 million divided by 50 gives us, it would be 100,000. 100,000 shares. At present, they already have 200,000 shares. So the total number of shares would be 300,000. If at all, if they consider the first option, that is proposal one, it would be 300,000 shares. Proposal two, anyway, they say that it is all bonds, so no additional shares would be issued. The present shares are 200,000. So the total number of shares would be 200,000 shares. If the second proposal is followed, in place of additional shares, they would be going for issue of bonds, additional bonds. So the total bond capital which would be collected will be 5 million. This 5 million will be with by way of issuing bonds, and the total capital collected will be 5 million. At present, there are no bonds in the company because the first line says that it's an all equity capital structure of common shares. At present, there is no amount of interest paid because there's no bond capital employed by the company. But the second proposal says that if they go in for issuing bonds and collect bond capital of 5 million, on this 5 million, interest will have to be paid at the rate of 10%. So let's just calculate how much would be the interest amount. 5 million into 10%. So that comes out to be 500,000. Done. There's no interest here in this particular situation. So now let's take it up. What is the requirement? The requirement is we are asked to find out what is EBIT EPS indifference point. Indifference point is a situation where we see that whether they follow proposal one or proposal two, whatever is the situation, there would be no difference. At some point, we see that whether it is proposal one or proposal two, there would be no difference. Difference in the sense, see, at some level of EBIT, which is considered under proposal one and proposal two, some amount of EBIT, whether it is under proposal one or proposal two, will ultimately give the same amount of EPS. EPS For some level of EBIT, EPS would be the same. That is the meaning of indifference point. EBIT, EPS. For some EBIT, and eventually when EPS is calculated, at that EBIT point, EPS will be the same. No difference, indifference point. But first, let's look into what is the formula of EPS. It says EPS is profit after taxes divided by number of common shares. I have pasted here the income statement format. Quickly, let's just understand. Now, if this is EBIT, see, EBIT would be after deducting all the operating, non-operating expenses, incomes, etc. We see that there is EBIT, earnings before interest and tax. From that, interest would be deducted. After that, we see taxes are deducted. Then, since here there is no mention about preference dividend, so preference capital is completely taken to be a zero. So this profit after tax divided by the number of ordinary or common shares when we divide, we would get it as EPS. This is the format. Just for our understanding, I just pasted it here. So now indifference point. Indifference point is proposal 1 and proposal 2. Both of them, under these two proposals, whatever is EBIT, at that EBIT, EPS would be same. See, under proposal 1, so if we are to find out what is EPS, okay, we do not know what is that EBIT. We are supposed to now calculate what is EBIT. So take EBIT as it is, EBIT minus. Do we see any interest here in case of proposal 1? Because under proposal 1, it's an all common stock or all equity firm. And also under proposal, there is no plan to issue any bond capital. So it's completely equity, completely common stock. So there is no amount of interest that will have to be deducted here under proposal 1. What has to be deducted? Only the tax has to be deducted. So EBIT into 1 minus tax rate. Okay. This will be EAT, earnings after tax. This earning after tax divided by number of common shares. This is situation 1, proposal 1 is equal to this. Since it is an indifference point, we will have to equate the first situation with the second situation. That is the second proposal. Now, under second proposal, what do we have? We see that EBIT is there. So, we see EBIT is there. Minus I is also there because interest has to be paid. We see interest amount of 500,000 is there. Okay, so this will be called as EBT. On this EBT, tax is paid 1 minus tax rate. Okay. EBIT minus I gives us EBT. EBT into 1 minus tax rate. Done. This is the amount of profit after tax divided by the number of common shares. Okay. What's tax rate? 40%. 40% is 0.40. How many number of shares are there? We see the number of shares here are 300,000. How many number of shares are there under proposal to 200,000? So let's substitute the data. We see EBIT into 1 into 1 minus 0.40. See, we see 40% can be written as 0.40. This is divided by 200,000 shares is equal. We do not know what is EBIT. EBIT minus how much is interest? Interest is 500,000. 500,000. Then this into 1 minus 0.40. And then the entire numerator, I put a bracket here. Divided by total number of shares are I'm really sorry. This is total number of shares are 300 here, and here we see the total number of shares are 200,000. Okay. We just have to substitute, simplify that, take 300 to the other side. Okay. So that becomes 300 by 200,000. So we can put it as 3 by 2. EBIT minus 0.40 EBIT, or we can put it as 0.60 EBIT. So this will be 0.60 EBIT. Take 300,000 to the other side. So it will be, we have EBIT minus 500,000 into 0.60. So we have it as 0.60 EBIT minus 500,000 into 0.6. 6 5s are 30. It would become 300,000. This entire thing we have to multiply into, because 300,000 comes to this side. So it will become into 300,000 divided by 200,000. So in simple terms, we can put it as 3 by 2, or it would become 1.5. Okay. Now simplifying this one further, it would be 0.60 EBIT is equal to 1.5 into 0.60. Just check that one. That calculation would be, we have it as 1.5 into 0.60 gives us 0.9. Okay. So 0.90 EBIT is minus 1.5 into 300,000. Okay. 1.5 into 300,000 gives us 450,000. Okay. Minus 450,000. Now, when we simplify, we have it as 0.3 EBIT is equal to 0.6 comes to this side and 450,000 goes to the other side. Okay, we have it as 0.30 EBIT is equal to 450,000. Okay, EBIT is equal to 450,000 divided by 0.30. So EBIT is equal to, this is 1,500,000. Okay. So the answer here is the last option, which is 1,500,000. Just go through the calculation carefully and then you would understand. Hope it is clear.